From the nation's capital in Washington, D.C., the Congressional Report, with your host, Iowa Congressman Latham.
This country is based on farms, on small businesses, and creating jobs and opportunities. That is the lifeblood of this nation.
And now your host, Congressman Latham.
Hello, and thank you for joining me. A financial crisis can shake a nation's economy to the core. Unemployment rises, credit freezes, and consumers lose confidence. Lawmakers in Congress are building their cases for what role they think the government should play in the financial sector to prevent the kind of economic crisis our country has experienced in recent months. The legislation has been filed to address the topic from a range of perspectives. Joining me today is David John of the Heritage Foundation to discuss the financial regulation and the economy. Welcome, David. Great to have you with us. Tell us a little bit about yourself, the Heritage Foundation. What do you folks do down there?
Well, that's an interesting question. My mother asks that fairly regularly. I'm at the Heritage Foundation. I'm a senior fellow. I'm their guy on financial institutions, and I do a lot of other topics like retirement and Social Security and things like that. We are a nonprofit, nonpartisan educational foundation. So what we do is we look at various issues, we try to find solutions, we try to find ways of doing things better, and then we work with members of Congress like yourself, we work with the press, and we try to get these things accomplished.
And your background as far as education, or where?
Well, I started out in journalism and then went down. I have an MBA in finance and degree in economics. I worked on the Hill for 4 members of Congress. I've worked in the financial services area, so it's been a fairly broad time.
You know, we've gone through a major crash as far as the financial markets, and what caused all this? Can you go back and give us the
I can.
the
It's a
reasons?
very complex. It's a mix that goes back, actually way back to the fact that there was too much money in the financial system, and that money came from Chinese trade surpluses. It came from high commodity prices like oil and things like that, and it came from mistakes that various financial entities, the Federal Reserve, the Bank of England, the European Central Bank, did with that. So essentially there was so much money in the financial system there that just like an agricultural price, the price of borrowing money went way, way down. People looked at it and said, well, now what can we do with all of this? And they kept looking for ways that they could make extra money on it. Government contributed to this by a very loose housing policy that basically said anyone who is living and breathing can qualify for a mortgage. Then we had financial services firms that got carried away and created products that even they didn't understand, much less how to value. And it all turned out to be a huge mess.
And it really came to a point, I guess, when Freddie Mac, Fannie Mae
Yes.
Went under. Then we found out about credit default swaps and all of those new products out there that were not regulated. So is that where it is? Is it the government, telling Freddie Mac, Fannie Mae, you have to make all these loans, and then the banks basically making loans that they could sell off? And
that was a big part of it. I mean, there was all this cheap money that was around, and we had government agencies that said, and this is a lot of different administrations, this wasn't just any one administration there, that said, go out and lend that money, and we want everybody to be a homeowner. And Fannie Mae and Freddie Mac, which were government creations, went out there, and frankly they took a lot of decisions that were more involved with their position in Washington and their position in the housing markets than in doing the right thing for the American people, the thing they were created to do. And the net result was that we had people shoveled into houses in terms they didn't understand, and we had people who were buying up prices of houses because they had computer models that were convinced that housing prices would just go up forever, and of course the price of nothing goes up forever. So there's just a tremendous amount of blame that can go around, but Fannie Mae and Freddie Mac have got to look themselves in the mirror and shake their heads and realize that they really screwed up.
Hey, is it a question of not having enough regulation, or is it a question of enforcement, or all the above, or what actually the role of government in all this? Where did we drop? Where was the ball dropped?
The ball was dropped in a bunch of different areas. I mean, frankly, people looked at Fannie Mae and Freddie Mac. Some of my colleagues at the American Enterprise Institute, for instance, Peter Wallison, started working on this 10 years ago and warning that this was a dangerous entity, that people were making assumptions about it that weren't warranted, and that they needed to be looked at and restrained. And Fannie Mae and Freddie Mac fought that off and did not. But one thing we can't say, and this is one of the popular myths that have come out recently, is that it was all due to the fact that the government wasn't managing things very well. I can make that argument in a lot of different cases, but the fact is that when it comes down to financial services regulation, the U.S. did as well as anyone else. And we have to look and realize that if you look at the banks in France and Europe, which are micromanaged down to the nth degree, they ran into problems that were in some cases even worse than what American banks ran into.
So what role should the government play in all this? Is there a greater role they should be doing? Is it just a matter of doing what they should be doing better, or what?
I think it's the second. I think that when it comes right down to it, other than the fact that the government created Fannie Mae and Freddie Mac and then didn't control what they had created and didn't recognize the risk that they had created, as far as regular financial services go, there really isn't a reason to go through and try to micromanage it. As we saw in Europe and in parts of Asia, that doesn't work any better than what we've been doing. What we need to do is to take the existing regulations and the existing laws and apply them better, and look to the regulators and say, listen, you've been hired to do something. Do your job. Do it properly. If there is blame, bring it to the attention of law enforcement right then and there. And that's something that was not done. There is not a case to go through, as is facing Congress right now, and go through and try to establish a brand new regulatory regime that's going to supposedly solve all our problems, because it won't. History shows that.
And really, that's my next question would be, with the bills that are before Congress, at this time, actually, as we're taping this today, there's a legislation on the floor. What do you see coming out of that? What are the stakes on all this? Can we do more harm than good? Can we actually improve the regulatory scheme?
Well, I mean, we're talking about legislation that's somewhere in the neighborhood of 1,000 to 1,500 pages long. And one of the things I've learned from working with financial regulations and things for 30 years now is that when you've got something that long, it's a mistake just to start with, because there are things that are hidden in there that are terrible. But this is actually going to be dangerous for regular consumers, because what is going to happen here is that Congress, if this passes, is going to establish a new consumer regulatory agency. And this regulatory agency is going to get involved with all sorts of consumer products. And realistically speaking, we're going to see financial innovation pretty much come to an end. Now, financial innovation gets blamed for some of these, and we've talked about credit default swaps and things like that. And there's some valid cases there. But the fact is that a lot of financial products have become a lot cheaper and a lot easier to use over the last few years, and that's already coming to an end. For instance, if you look at the credit card bill that Congress passed earlier this year, and some of us warned that, well, I know that the supporters of that were well-intentioned, but what was going to happen is that some people who most need the credit were going to be denied it.
Right.
And sure enough, a number of people that I know, and I'm sure a number of your constituents, have received letters from their financial institutions saying, well, guess what, we're going to cut your credit amount. Maybe we may cut it in half, we may close your card or something like that, because of all the regulations that were put in from this credit card bill. We can't afford to offer you credit anymore. And we're going to see more of that.
The banks also, or a lot of the major credit cards, increased the rates too before the bill actually went into effect, which very difficult for a lot of people to withstand when they're in
absolutely
dire straits anyway, and then have the rates go up like that.
Yeah.
You know, looking back at what happened, obviously nationally a lot of the institutions had real problems. They got in trouble with credit default swaps, Freddie Mac, Fannie Mae. You know, and then we had the TARP, the $700 billion that Washington provided to basically bail out the credits, the banks supposedly to offer more credit so that they would go out and make loans and to stabilize the institution. Tell me about TARP, the $700 billion. Do you think that's well spent, or what? I think there's about $200 billion left today. There's some of that money is being paid back, but what's your opinion on that?
Well, TARP was created at a point when we really did face a financial crisis. I mean, some of us looked at some of the numbers that were coming out, and we were within a matter of a week or so of the entire financial system failing. And at that point, we had a number of well-meaning regulators who basically said, hey, we've got to do something. And they were approved to have this $700 billion. The good news is that we can say that the crisis didn't happen. And whether that was TARP...
I was going to say because of TARP or in spite of it?
We'll never really know.
Okay.
I mean, that's the problem. The real problem then was that some of us warned at the time that TARP... Well, anytime you've got a $700 billion pool of money, which is almost inconceivable in this term, it's going to be used for all sorts of things. And sure enough, we had a new administration come in, and suddenly it's being used to deal with General Motors and Ford, which the last time I checked weren't financial institutions. They're talking now about using part of it for some sort of a government jobs program and the like. And we can say completely, it was mismanaged. It has been used for many things that it shouldn't have been used for. There might have been an excuse back last October, 2008, November 2008, for some sort of emergency measures there. But by December, January, and whatever, it was time to start to close that down. And that hasn't happened.
Well, and that's, I voted against it, strongly believed that it was the wrong thing to do. And and just I think to your point, one of the major parts of that is the fact that we basically gave the Secretary of the Treasury a blank check for $700 billion saying you go spend it however you want to.
Yeah.
And that, I mean, number one, it's not good stewardship. Number two, to put that much faith in one individual, and at that time, Secretary Paulson, what it appears has happened, and I'm more concerned about Main Street, the finance, the banks on the corners, rather than what happens on Wall Street. And this has had a dramatic impact on Main Street banks as far as availability of credit, everything else. The auditors come in, the examiners come in the back door and say don't loan, while everybody else is saying you should be loaning. Has it worked? I mean, what should we do with the money that's left?
Well, frankly, what we should do is close it down. We should have closed it down months and months ago, and take that money and reduce the deficit. I mean, when it comes down to it, we're talking about last year, we spent $1.4 trillion more than we had. And I've got 2 daughters, and the last thing I want to do is to leave them a world where they're basically paying for the rest of their lives for my mistakes. It's time to close it. And what it did in Main Street actually is precisely the problem, because we had a bunch of panicked people, bank regulators, as you said, and these are, again, fine, well-meaning people, but the last thing they want to do is to have a bank that they examined close down. So they're going into small banks and they're saying, yes, you may have operated this way for 75 or 80 years, but if you continue to operate the way that you always have been, making profits, etc., I'm going to write you up, and you're going to have more problems dealing with that. So we've got our neighbors in West Virginia, and I'm sure many of your constituents, et cetera, who used to be absolutely fine for their credit ratings, and now suddenly they can't get a loan to save their lives.
I think examiners coming in the back door saying you have to write down the credit line for this. You know, we're not making loans for this type of business anymore. All of those things that have just really contracted availability of credit. Is the crisis over with?
We think so, for the most part. There's still problems with commercial real estate, and those commercial real estate problems are predominantly in smaller banks, and they're probably going to continue to show up for the next 6 months to a year. Barring any sort of sudden shock, and we were worried, for instance, when the Dubai agencies defaulted, something that spooks the financial markets, I think we're on the road to recovery. But it's going to be a little fragile for a while now.
Okay, the big question, when do the jobs come?
That's the one I wish I could answer. I'm afraid, realistically speaking, it's going to be a while. This is going to be a slow, steady recovery if it's handled the right way, and that's, of course, another question in the world. And realistically, we'll probably start to see some job growth in about 6 months or so, but it's not going to be the kind of job growth. We're not going to be back down to 5% unemployment or anything like that for quite a while yet.
Well, you know, we passed in January $787 billion of a, quote, stimulus package.
Yeah.
That was supposed to, and the administration said at that time that if we pass this, unemployment would not go above 8%. If we didn't, it may get up to the mid-9s, percentage of unemployment. Well, we're at 10% unemployment today with the stimulus package. They're talking about a second stimulus package. What happened with the stimulus package? Why hasn't it worked?
Well, it hasn't worked for a variety of reasons. For one thing, a congressional stimulus package, pretty much by definition, is always targeted at the wrong things, because the time between when it's passed and when it's actually implemented, the economy changes. But the biggest problem that we faced was that we had this same old business go forward. So every port program that was out there suddenly had a new way of being passed. And we saw the House and Senate leadership pack just hundreds of billions of dollars worth of projects that should never have been funded in the first place and had absolutely nothing to do with financial recovery. It's just, here was their opportunity to pass something.
Yeah, it was, meant to be jobs. The reason I opposed it, the idea that there was going to be a lot of money going into infrastructure, creating jobs, shovel-ready, all of those things. And the fact of the matter is, less than, I think, 4% of the bill was actually targeted to roads, bridges, the kind of construction that people look at as far as what is would create jobs. There's more infrastructure money, but a lot of times those are long-term projects that have no effect. But we're still spending this money, and it's basically gone to intergovernmental spending rather than out into the private sector. So what should we do today?
Well, what we've got to do is recognize that we are on the road now to spending our kids and our grandkids into poverty. And that just because the United States has been a great economic power, and I'm not predicting that it's not going to be, but if you're irresponsible with your stewardship, and I'm talking about all over the country here, our kids are going to find themselves in a much worse spot than they have any need to be. I'm personally very worried.
I think all of us are. I serve on the Appropriations Committee, and the omnibus bill that is being put forth right now, which combines 6 different appropriations bill, but is 14 to 15% increase over last year for all of the bills. But the fact of the matter is, non-defense discretionary spending here in Washington in the last 2 years has increased 85%. I mean, it's unbelievable. It's not sustainable. It's, like you mentioned your daughters. I've got 3 children and 4 grandchildren, and we're passing it not only to grandchildren, our great-grandchildren.
Exactly.
Well, what happens when, according to the president's budget, we have, in the next 10 years, we triple the national debt. We'll be up over $20 trillion actually on the books. Is that sustainable?
No, it's really not, because the problem with the national debt is that you have to pay interest on it. You have to pay interest over and over, and those notes are rolled over, which means that the new higher interest rates are going to come into effect. Right. And that basically is money that our kids will be paying for decades there, and they're not going to get any value of that, because that money is spent and gone. And as we've already discussed, despite your efforts and others, it's mostly been misspent.
Mm-hmm. Getting back to the financial regulation, what's before Congress today, what exactly should we be doing?
It really should be fine-tuning rather than passing. And unfortunately, the bill that's before you right now includes an awful lot of utopian ideas that have come out of a wide variety of universities and the like. And they're fine in theory, it's just that they don't work in practice. So rather than creating a new agency, rather than trying to micromanage every aspect of the financial services arena, it would be far, far better to look at what went right and what went wrong, and to strengthen enforcement, and to make it very clear where the responsibility lies in the future. And Congress has an oversight responsibility, and that oversight responsibility really hasn't been followed recently. It is time to call people in and say, okay, now what's the deal here? What's going on, etc. And that can be done. It doesn't need 1,400 pages of legislation to do that. It might need, if you space it widely, it might need 20 or 30 pages to do something like that.
I get a lot of questions about the role of the Federal Reserve in the economy, and what they have done, what they haven't done, how they're secret, they should be audited, all of those things. What's your opinion? What's their role? What should they be doing, and maybe that they haven't been, or going forward, what should they be doing?
Well, the Fed was created to deal with the money supply, and it's a bunch of very technical individuals, etc., and for the most part they do a relatively good job with the money supply. They screw up periodically, but it's there. But they also have developed a role in financial regulation. And I believe it's important for them to have some small role, because they need to have direct connections with the bankers so that they understand what's going on and how they can base their monetary policy. But at the moment it's become an empire, and it is far greater than it was ever intended to be, and it frankly can be trimmed down without too much problem there. They need to be independent. This is actually a very crucial element there. The last thing, frankly, we need is something like England in the 1950s, where every time there was an election, suddenly there was inflation and more jobs were created, and then right after the election everything collapsed. But at the same time, they need to be held accountable. You need to know what they're doing, and frankly, so do we.
Should they be audited? I mean, in some way, for the American people to know how much money they're printing down there, what they're doing with their money. This is all money that's off budget.
Yes.
I mean, they've printed billions and billions of dollars in the last few years.
They need to be examined. They need to have it very carefully, but it's got to be done very delicately, because, again, the last thing we want is to have political interference.
Yeah. Well, and that's political interference. A lot of people will make the case that's what happened with Freddie Mac and Fannie Mae.
It is.
The mandate that they had as far as making loans that, subprime loans, all of those things that...
And they took that mandate and they ran with it. They ran the biggest government relations business in the U.S. in Washington. They had the biggest political action committees, etc., and they knew how to manipulate things.
Yeah. Is there any way for the government or the agencies here to be able to anticipate? We're always reactive, and there's nothing more frustrating in this place in Congress than to see us continually have crisis that we have to put the fire out. Right. Is there any way we should be doing proactive, looking to the future?
I think the answer is yes, but yes, there is a need to have more information and have better information that's out there. But we have to recognize that there have been economic cycles going back several thousand years, and no law that's passed out of Washington, D.C. is going to repeal the laws of economics. And it is not possible.
Congress tries every year.
They do, actually. And I'm hoping they'll do the weather next, actually. But that's... But so, I mean, it has to be realistic. There is no way of stopping future recessions or anything like that. It is going to be possible to anticipate them better. But the more you try to micromanage it, the worse it's going to be.
Yeah, a lot of people have had a lot of press about the idea of banks, institutions too big to fail.
Yeah.
What's your take on this? I mean, should we allow some of these massive international AIGs fail?
Yes, absolutely. The danger that we ran into, and this is one area that can be worked on, is that we don't have at the moment a method to resolve these things. So we had an AIG, and AIG, if it failed in its current situation back in 2008, would have caused an absolute disaster, crisis. But all we had as taxpayers was the ability to either hand them money, which came very close to blackmail, or to or buy it. And the last thing we need to do is to buy something from that has failed in the first place. So what actually is needed is a better form of bankruptcy, so that we can look at these institutions, we can watch them as they grow, and we can make sure that they have adequate resources to close them down. And then when they reach a point where it's a problem, that's it. Capitalism is all about success, but it's all about failure too.
Right. Well, is there a reason to have, and because a company like AIG, international operation, and a lot of their biggest problems were as a credit default swap office they had in London that generated about 25% of their profit, but also had unbelievable liabilities that they weren't even aware of. Is there an international regulatory scheme that we should be looking at?
Well, we can look at that, and that's more of a matter of information sharing. The danger that we have is that other countries, for their own ends, try to manipulate our domestic markets so that basically they protect their banks and they hurt ours.
Okay. I could go on and on here, but I see that we're running out of time. So financial regulation really is becoming the hot topic here on Capitol Hill, and certainly after all the turmoil that's plagued the financial sector in recent months. How to keep track of the financial service industry is an important question, and one that can have important ramifications for our entire economy. I hope that the show today was offered to you some insight into a complex and critical issue for our economic future. And I'd like to thank our guests, David John, for being with us here, and I hope you'll join me again next time on the Congressional Report.
From the nation's capital in Washington, D.C., this has been the Congressional Report with Iowa Congressman Tom Latham. Have a question, comment, or concern? Congressman Latham wants to hear from you.